Margin trading can be a pretty important concept to understand for traders. So let's start off by defining margin trading. Margin trading involves borrowing money from a broker to buy more securities than you could with your variable cash. So we're basically just borrowing money from the broker. We're essentially taking a loan from the broker. We could start with a smaller initial amount of money, and then through the use of margin, we can borrow some more money and then have a larger total investment. Now, this sounds appealing, but there are some downsides to it as well. So, the key features of margin trading are that you can use your investment pool as collateral. So, your investment pool acts as collateral to allow the broker to take on the risk of basically lending you this money in the first place. Kind of like how with a mortgage, your home would be used collateral, which allows the bank to lend you that money in the first place to hedge their risk. So it enables the use of leverage. Just like a mortgage, you're borrowing money to buy more than you originally could have purchased. This will amplify both gains or losses. That's what makes it more risky. And then we also have interest payments, which are based on the borrowed funds, which accrue interest, and then you must pay that interest back to the broker. Let's talk about some of the risks involved with margin trading. And it is a pretty risky activity. So, with margin trading, you can magnify your losses. So the losses are amplified and the borrowed funds must still be repaid. Even if you lose that money, you must still pay back the broker. I had a friend who owed over six figures or over 100,000 USD to a broker from margin trading going the wrong way. He had to take out a second job to end up paying back those debts. Very risky activity. Another risk is the possibility for margin calls. So brokers may demand additional funds, or they can even liquidate your assets if your account equity falls below the required level. So you're going to have some required level for your account to maintain, and if the equity falls below that, then they can essentially force liquidation on you. So the brokers can sell your assets without notice if you fail to meet the margin requirements. So the assets in your portfolio, like we said earlier, are being used as a collateral that the brokers can take back. And then finally, the main reason that I never really margin trade myself is there's interest costs associated with it. So you're borrowing funds from the broker, they accrue interest, and this increases the cost of trading. So that lowers the probability that your trade would ever be profitable because you first have to exceed the interest costs in the first place. Now, different brokers are going to have different interest costs. So I'll show you an example real quick. Now I'm over here on Interactive Brokers to see what margin rates they'll give me right now. And so I can enter a balance of USD. Let's say I have $10,000 that I want to put into an account and see what rate they'll give me. So I can now calculate blended rate. Keep in mind they have two separate pricing plans. So we're going to be using the Pro plan, which has cheaper margin rates. So with just $10,000, all of it falls into this tier 1, which is an interest rate of 5.83%. Now, let's say if we were more of a big baller and we could put $500,000 into a margin account, let's see what's our rate now. It went down from 5.83% to 5.43% because only $100,000 went into that first tier with the higher interest rate. And then as we added more, we got more money, or $400,000 in this next tier at a lower interest rate. So basically, the more money you put into a specific brokerage account, and this is pretty much how it works with all of them, not just Interactive Brokers, basically the cheaper interest rate they'll give you because they want to incentivize you to put more money in their service. I'll put the link to this calculator in the description or the text of this video. And since I spent a lot of time talking about the risks or the downside of trading on margin, I think I have to do it justice by talking about what are some of the benefits, or why do some people even do this in the first place. Well, the biggest reason is that it increases your buying power. So let's say you really had a specific view about some asset and you think it's going to perform really well, and you want to take a larger position than what your actual cash balance would allow you to take. Well, you can trade larger positions with the less upfront capital because you just borrow from the broker to fund that purchase. But remember, with that example I just gave, if you were at that lowest rate, let's say it was 5.81%, this investment that you're increasing your borrowing power in really needs to have a return that outperforms that for it to become more profitable. Now, it has the possibility for enhanced returns. So we can get these higher profits that we'll realize if the investment performs well. So if the investment rate exceeds our borrowing rate, then we should have enhanced returns. And then finally, another big advantage is the flexibility that it provides. Margin can be used for short-term opportunities or to diversify your portfolio. This video is a part of my course, Options Theory to Practice. I'll guide you step by step through the fundamentals of options, all within a safe and controlled paper trading environment where no real money is at risk. You can learn more via the link in the video description or pinned comment.